for being with me for this Danielcode tutorial. And thank you, Lockie. All right on the ball, my man. You can hear me all right, and you can see the screen as well. So there's two of our biggest issues of the day that I've dealt with. Thank you for that, my friend. I hope you're well. Anyway, we have all our usual trusty and loyal supporters with us this evening. Wonderful to have you here. Bob's here and Trevor's here. Peter Mack, who's not a day trader. Many other Peters. We have a large number of them. Let's see what else we've got here. Okay. So, oh, Stephen's with us. Haven't seen you for a while. Welcome, my friend. Eyes need a bit of adjustment here. Andrew's with us. Michael, haven't seen you for a long time. Michael Fowler, glad to have you with us. Terrific. Many other Michaels, of course. Who have we got here? Oh, Rodney, nice to have you with us again, my friend. Been with us on and off for a long, long time. Steve, as I say, is with us. Andrew's with us. Many Trevors. Julian's with us. Jeff is with us. All of us. Jeff's just done a tutorial. He's a very keen Danielcode guy. And all our usual friends are here. Wonderful to have you. I'm glad that you have the opportunity. Oh, Florian's just arrived. Oh, many are arriving. Okay. Well, there's a whole lot of you coming in at once. That's grand. You can count on me to start at 1 minute past the half hour. So, but you haven't missed anything yet, folks. That's the good news. Okay, let's get moving and see what we've got today, because it was a nice, pretty exciting day's trading, wasn't it? And I guess any of you equity traders have got your pockets full. And it's just working to plan so beautifully, as I'll show you. So as we know, markets are rational, orderly, and sometimes predictable, as has been this case. As those of you who follow the Danielcode on a regular basis will be aware that I posted a detailed post of why we were likely to have perhaps a substantial pullback in equities markets, and that has come to pass, and it's been very tiny. So today's themes I want to talk to you about is a number of points. The first is that the greats don't know what they're doing. I'm sure you've all got your favorites that you slavishly follow, and on Twitter, now X, on other various formats, and we all have this inclination that we tend to think that the big boys know what they're doing, and the answer is they don't. They don't know any more than you know, because none of us know the future. The future is reserved for the great one. It's not for us to know. So I want to talk to you about that. Also, I want to talk to you about options. Because I've got a new client. He's a wonderful gentleman in Europe. He's probably sound asleep tonight at this time. He is a retired economist, but he's been interested in markets for many, many years, and he now wants to become a serious player in the market. So he's doing the Danielcode Beyond Masterclass, the full the big one-on-one tutorial with me, and in the process he asked me would I be teaching him how to trade options, because most of the people in the financial world that he knew, and he knew a lot, were options traders, and I had to point out to him that options really are for folks who don't understand markets. They're a bet with a limited time cycle, and the best of them in the business are doing not much more than guessing, as you'll see as we go through today. So timing market moves is dangerous, and it has consequences. So if you are interested in market turns and market moves, make sure you're following someone who's got a good track record, and none is better than the Danielcode. So the safest trading is to stay close to the markets. Once you're taking a bet on a time frame that maybe some considerable time away, you're really guessing. And sometimes those guesses work, most often they don't. But the Danielcode rules all markets in all time frames, and that's why we stay close to the markets. This is the post that I was talking about on the Danielcode website. And I've recreated it here in a few little pieces. And this was posted at 7:50 a.m. GMT, which is, I think, 4 or 5 hours ahead of US Eastern Time on November the 4th. And what I was pointing out to you is that we've been tracking possible turns in the futures market, or the futures charts, for probably 6 weeks or so. And what I've written here is that attention now shifts to the S&P index, and there are subtle differences between the index and the future charts. Generally, the futures count has been running ahead of the index count, but the index is generally the most powerful, and its time has arrived at a vital stage, and here it is. And what I've shown you there is the 24-day chart. Danielcode time cycles work on 6-day charts, 12-day charts, and 24-day charts. And this is the 24-day chart. And you can see we've had a concurrence of time cycles. We had, in fact, 4 time cycles on the last of those upward posting blue arrows. And I went on to explain a little bit more by saying this chart's been so long in the baking, it's hard to decipher because it's got too many details on it. So below is the detail. It says, since 2020, I've been boring you with my assessment that the COVID flash crash high was the new bulwark for equities. A bulwark is a solid piece of structure, usually used in regard to ships, and it's the part of the hull that extends above the deck of the ship that keeps the spray off and that sort of thing. But it's a very important, very powerful point. What I've been arguing is that the COVID flash crash high was the new bulwark for equities, and today's high on the 24-day chart came just in time with our first and oldest tool, the famous Danielcode time cycle, screaming that time is up for this long-running party. 59 cycles, the dreaded DC measure of time times and a half, and so it is. Last day for the 24-day cycle. A proprietary DC measure, like everything else we do, ends on November the 4th. And that is today for us dwellers in the land down under. And I then posted this chart, which took us right up to the current time. And I had a comment underneath it, hard hats required shortly. Why do you need hard hats? Because the market's probably going to go down and hit you in the head. And you can see we had a very, very powerful 59 cycle running all the way directly from the COVID flash crash in March 2020, which I maintain is the new measuring point for time cycles. Doesn't mean the old measuring points have gone. The 2007 high, 2009 low are still very important, and they're still vibrating. And these vibrations, once they're established, they can go for a very long time. And you can see that this particular measure is a very long time. It's 59 cycles on our 24-day chart. So that's, 59 lots of 24, and every bar on these charts has 24 trading days in it. So you're talking about, Clacky goes on the calculator, 1,416 trading days. That doesn't include, of course, weekends or market holidays. And that's where we are from the COVID flash crash. That's a long time. And we've got all of these cycles combining. And I thought that that could very properly lead to a decent pullback. And there are all sorts of reasons to be suspicious of the market at the moment. You should always be suspicious of the market, but there are times when it will prove to do more so than other times. So this has got today's data on it now. I've just updated for you. And the probabilities are that the last completed bar is going to give us the closing high for this whole move up. A very, very powerful move up. And that would just be perfect for the expiration of a number of Danielcode time cycles. And you can see there for the just completed bar, let me tell you the exact date of that, which will be here somewhere. Here it is. That's the week ended November the 5th. That's the previous bar that completed on November the 5th. And it's very likely, in my view, that we'll get the closing high on that bar. These time cycles work off swing highs and swing lows, but they also work on closing highs and closing lows, and they can switch around. And one of the best switches that we've seen, the timing cycles are always subtle. They're never obvious. When you think you've got it all nutted out, you've obviously missed something. And you can see on this chart in the bottom right-hand side that we had a 62 cycle that I thought would be important, and it went through that. And then we had the next 62 cycle, which is right where we are at the moment. So there's much of interest to us here. Okay, and let's see where we go. Here we are. So the big news today in the financial world is that Michael Burry, Dr. Michael Burry, the headline, I should say, in Zero Hedge, which Lockie, who's with us today, David, doesn't like me using quotes from Dave from Zero Hedge. He thinks I should go to someone else who he thought was much more accurate. But I don't read anything that relates to actual trading. People who have a view of you should be long, you should be short, I don't read that stuff. I don't want anyone else's opinion on what they think the market is going to do. All I'm interested in is what I think the market's going to do. But more importantly, even than that, that's not what I trade. What I trade is the Danielcode daily signals, Danielcode time signals, which we've proved to you so many times and over such a long period that they are the answer to all of your questions. And we're particularly delighted to have Justin with us today. Justin's a young gentleman from New South Wales, which is down in the Hunter Valley of New South Wales, a state just a bit south of us here in Queensland. And Justin has done so much work on analysing equities markets and Forex. He's actually done a massive piece of research where he's taken over 100 years of data across all of the markets, equities markets we cover, commodities as well, precious metals, anything you like, whatever we cover, he's covered that. And he's covered a lot of other markets that we don't cover. He's also covered all of our Forex markets and some other Forex markets as well. And what he's found is he's given us the results in a very scientific way. And you can see all of that on the website, the Danielcode website, where I've listed 4 videos that are there for you to watch. Video number 2 and video number 4 are from Justin. And you really should take some time, if you do nothing else in the next few days, make sure you watch video number 4, which is Justin's research over years and years and years. And it's so incredibly generous of him to share that research with us. It was a massive undertaking, and it really tells you everything there is to know about creating and trading Danielcode time signals. So I digress, because the big news today was that Dr. Michael Burry had a rage and quits the market altogether and has liquidated his hedge fund. Well, who is this guy? Well, he's a big player. He's been a big player for a long time in the markets, and he was the central character in the movie The Big Short, which is basically about the 2007 to 2009 bear market, where all of the various collateralizations of mortgages, a whole lot of them were found to be pretty shady and not robust at all. In that movie, if you have a chance to watch it, if you haven't, do watch it. It's called The Big Short. And it's a wonderful commentary on life as a trader. Dr. Burry got some of the credit, and he should have got all of the credit, because he's the only one in that particular movie who worked it out for himself that the collateralization of mortgages was very shaky and much more risky than it was being presented to be. The other players in that film, they found out about it accidentally. One of them, the other main player, took a phone call that was intended for someone else, and the chap on the other end of the phone was telling him that these collateralized mortgages were not very good value as securities. So they had a ride on Michael Burry's coattails, but he was the original. He worked it out for himself. And he's an options trader. The big plays you see are often in options, more often than not. If you read on a little bit, you'll see that what he's done recently is he's gone short Palantir and NVIDIA, the two biggest players in the high tech, the big tech bubble, and it is a bubble. It's all based on the narrative about artificial thinking about artificial insemination. Do forgive me, I'm thinking about my poor bloody cows. Artificial intelligence, and he took out a big position some length of time ago, and yesterday, before the market had its last little jink down, he closed off all of his positions pretty much, and closed and gave notice that he's going to close his hedge fund and return the money. So there's a big player, one of the greats, often quoted, has lots and lots of followers, and no idea. Was, in my view, probably right about the direction, but time can kill any strategy. It can kill option strategies just as much as it can kill future strategies. But future strategies get killed much earlier because the leverage works both ways, as you know. So that was the start of that big story, and Zero Hedge took it up, and you should read this. And it goes on to say that he's taken this massive position in two of the really leading AI markets, and some will declare that Burry putting the money where his bubble bursting mouth is a sign of the top. We have two words of caution. Back in 2005, he was early by about 2 years, and this was his call for collateralized mortgage bonds, CDs, to crash. And of course, ultimately he was right. He got the trades right. But the carry, because when you're in these positions where you've got an open position, you got to pay the carry. And the carry is, as the market moves against you, you got to pay up. And before this great gamble on the 2007 being a top with a serious correction to come, before that started to play out for him, pretty nearly ruined his hedge fund anyway. Second, they say the last time Burry tried to top tick the market was January 2023, when he blasted the one word sell. Market is up 69% since then, so no great marvel, but does deserve credit for being the only original player that we know of in the 2007-2009 market crash. And they go on to say by Thursday night, but it said both these names he shorted, had options to short, are sharply higher, and he's already suffered substantial losses on his positions. By Thursday night, he clarified details about his recent bearish bet on Palantir, noting he bought 50,000 option contracts at $1.84 each, representing 100 shares per contract, etc. Total of about $9.5 million. And he sent a letter to investors late last month saying he was going to liquidate the funds and return capital. He says, my estimation of value in securities is not now and has not been for some time in sync with the market, which is a polite way of saying you've done your cash, guys. Anyway, that was of interest and should be getting you to think a bit about markets. And markets repeat constantly. That's what they do. They repeat in cycles of time. They repeat in cycles of price. Nothing is new under the sun. What has been is and shall be again. Believed to be written by King Solomon in the book Ecclesiastes, which is an old market text. Excuse me. So the biggest problem that we have in trading is mark to make believe, what I call mark to make believe. That's not an original expression, incidentally. But the whole concept of markets is that securities should all be marked to market on a regular basis. When you're trading a market that's publicly traded, you get the number every day. And despite what you may think or hope, the number that the market closes at for the day is the value of that security. And there's really nothing else comparable that can mark it. But a whole lot of what's happening in the market, I'm talking now about private debt, it's all off market and it's not mark to market. And you've got some serious players in the industry taking the view that these securities were all still worth par when they're not worth par. That's mark to make believe. And some of the biggest players in the market do it, and in fact it's sanctioned by no less than the US Federal Reserve, who the last time that bonds had a serious bit of a skid came out and changed the rules and said, oh, well, you can mark this stuff as that you're going to hold it until maturity, in which case there's no loss because they're US government bonds. But it doesn't reflect the true and accurate value. It's a basic fundamental breach of the basic accounting principles that all of these public corporations swear by. So what I think is happening is I think inflation, by the measure of the man on the Clapham omnibus. You see that expression? The man on the Clapham omnibus. Isn't it wonderful? And that actually comes from a very, very old decision of the Privy Council in London, Britain's highest court. And they were discussing what would qualify as reasonable behaviour. Sometimes your only defence to something that you've done is that your behaviour was reasonable. And of course, there's been endless arguments about what constituted reasonable, what were the special circumstances, what were the circumstances on the day, etc., etc. And the Privy Council, to clarify that, this is a very old judgment, many, many decades ago, said the proper test for reasonable is the man on the Clapham omnibus. Now, Clapham's a suburb of London, and the omnibus is the old name for buses. So if you want to know the measure of a reasonable man, you should pick as your example a man who goes and catches the bus every day and goes to work with a whole lot of other people. That's the measure of what's reasonable. And I think reasonable at the moment should have your antennae prickling. I mean, there's an awful lot of things that can go wrong in the market, and we're starting to see a few of them leaking out. There have been some massive damages done to the big auto companies because auto loans are defaulting at a frightening rate. There's been more than a whiff of troubles in the private credit market for the same reasons that these private credit, the guys running the businesses, have been marking their securities of mark to make believe. In other words, they're still full value, 100 cents per dollar, and it turned out they were not, and nowhere close to it. And this, of course, don't forget, this is what set off the 2000 crash from the dot-com top and the 2007 to 2009 equities crash. Exactly the same thing. The equities had not been marked to market, they'd been marked to make believe. And when push came to shove, the value was gone. And private credit has been a huge growing part of the finance industry, and it's the big bear. And a couple of those have gone very wrong recently. So, you know, we're seeing these problems, and they're not new problems. Nothing's new. What has been is and shall be again. It's just a different version, a variation on the theme of pretending that there's market value when there's not. And the great unwashed, that's 90% of traders, they haven't learned about Danielcode. I classify them as the great unwashed. They've never seen a bear market. They have no idea what the possibilities are, and they certainly will have no idea what to do when it bites them. And quite a few have been bitten today. And gold and silver, of course, are the tell. There's a reason why gold is at such fantastic highs. There's a reason why silver has had such a bullish run up. And what they're really telling you is a loss of purchasing power in the US dollar. So if you like, purchasing power deflation in the US dollar. And that's what gold and silver are screaming, and it's real. And I've been rabbiting on about inflation, domestic inflation, what the man on the Clapham omnibus would measure as inflation. It's nowhere near 3.2%. I can tell you it's close to 13% than 3%, much closer. And the central banks, if you're not aware of this, have defined the tools they use to exclude what they call markets that are volatile. So when they're talking about inflation, they're not counting fresh food. They're not counting the food you buy at the supermarket or at the pantry. They're not counting petrol. They're not counting I'm wondering where Kit is. This nice gentleman from North Carolina who always tells me they're not counting interest rates. But inflation is in real terms much, much higher than the officials are reporting. And this is all being fueled into this narrative. Remember, I've talked to you about narratives. Markets rely on narrative. Someone sets the narrative, others support them. It becomes the purpose of markets. And at the moment, of course, in this massive, incredible, amazing bull market in equities and many other things, the narrative is artificial intelligence. And as I have said to you, there is no such thing as artificial intelligence. It's just Google on steroids. In other words, it's creating it, and Google wasn't new. All Google was doing was an electronic version of Encyclopedia Britannica, which had been around for 50 years. They were taking large amounts of publicly available information and storing it in an electronic fashion. And what this so-called artificial intelligence is simply that there have been massive, massive improvements in what coding guys can do with the data. These new chips, which are the be-all and all for tech people, are so powerful, are so advanced, are so incredible that they can do really amazing things. And don't forget the old saying, new technology to primitive people looks like magic. And at some levels, we're all primitive people. If you're a person like me with absolutely no knowledge or understanding of the tech world, I mean, I still do all my numbers with 3 fountain pens that have different colored ink in them. Can you believe that? Most of you have never ever seen a fountain pen, but I can do the numbers quicker than You can do them in a web sheet. So but that's just my problem, that I'm not technologically literate, and I have no real interest in it. But AI now, some of the things that these companies are doing are, in my view, patently illegal. There's some massive levels of spherical funding going on, where a group of companies, they've all got GPT in the middle of them, are lending $100 million at a time to another company with the purpose that they will buy chips, and then the chips will go off and be sold to the end users, and then the cycle will start again. Under most accounting systems, that certainly would be illegal, but it's going on. And the whole world of government, with very few exceptions, seems to be so beholden and falling into this that they're going to finish up on the hook for the funding. There was an amazing article yesterday that I think, don't quote me verbatim, in about 5 years' time, the requirements, the power requirements for all these huge data centers that have been built to house the massive numbers of computers that it's going to take to run AI in the future, they're going to have a shortfall of about 24 nuclear power stations in America alone. Can you believe that? So, as it says here, this whole AI push is now asking for astonishingly large numbers, and it will take $5 trillion to fund the AI cycle. And the scary thing is the US government is on the hook for over $1 trillion already. Why is that? Why would that be? I mean, you'd think governments have an obligation to be prudent with the money. It's not their money, it's your money, it's the taxpayers' money. It begets great problems in my view. So let's have a look at where we are just in our current trading cycle. The big tell about what's been happening has been disorganized markets in the equity space. US equities and Germany's DAX are usually very highly correlated. They're highly correlated directionally, and they're also highly correlated, not in such a high way, but still basically correlated in the levels at which they're going to. So I want to show you what these equities all look like at Wednesday's close. Correlations tell you very much. And we're going to focus for the next few charts on the famous Danielcode black line. And the black line, Danielcode black line, is 89.2% retracement of any trading range. It comes straight from chapter 12 of the book of Daniel in the Old Testament, and it is the last level of support or resistance for any operating swing. So that's where it was, and it was released by me when our first website went public in late 2007, long time ago, wasn't it? But it became famous 6 months to an hour to a year later when Sanjay, one of our clients in India, he was working for one of the big international banks in Mumbai at the time, and he wrote to me to say how excited he'd been using the Danielcode black line in his analysis, but that his representative from Bloomberg had come to visit him, and working for a big bank, he had a Bloomberg terminal, and this chap came to tell him, look, we've made this wonderful new discovery. If you take these numbers and that numbers, multiply it by the number of chickens, deduct your grandmother's age, you come up with 89-point-something%. Isn't that amazing? And we're calling it a black line, and we're adding it to the Bloomberg data pack terminal. So they made it famous, and a lot of people are aware of it. It is quite extraordinary. It's original Danielcode stuff. And when you're looking at markets, it's often useful to simply look at that black line if it's in action. And you can see here, that from the recent swing low 5 days ago, the black line, this is the Dow, was at 48,000 thereabouts. And the day before, today to Wednesday, the close was just a handful of ticks below that black line. And that's very common. Markets will go to that black line, have a serious think about whether they can go past it or not. Excuse me. If they can close above that black line, the probabilities are that the swing high will be taken out, and those probabilities are quite massive. That happens all the time in markets, and it gives you a good measuring point. As you can see, this market, the Dow, ran straight through the black line to make a new all-time highs, and that was a very, very bullish signal. Now, have a look what's happening in the rest of the markets. This is the S&P. The last bar you can see is Wednesday's price. You can see there is a black line there at 6881 and 50 cents. And let me just find that chart. S&P. Yes. So that black line $6,881.50, and you can see for the last 3 days, including today, the market could not close above that number. It's very, very close to that number. In fact, it had a close on Wednesday of 6,875. It's really extraordinary how accurate this thing is. And my guess is that not many of you know about it, because I don't think many of you are actually taking the time to go to the Danielcode members charts, which are updated twice a week, sometimes more often if required, and they show you this stuff. You should be screaming to yourself, this market has failed on 2 consecutive days to close above the black line. There's a real possibility of a reversal. If you didn't know that, don't worry, the Danielcode told you. Our TO3 signals were roaring it for today. Here's the NADAQ, similar sort of thing. It had its black line of the minor retracement, didn't even get close to the main black line, which is up at 26,000. And the black line on the minor retracement, 25,700 odd. And you can see it just simply couldn't close above it. 1, 2, 3, 4, 5 days challenging that number. Today it fails. No surprise if you knew how to read charts. Here's the Russell. It's been rallying. What did it do today? On Wednesday, rather? It hit the black line of 2847.9 was the black line there. The high on Wednesday was 2487.6. You got that? 3 ticks difference. That's how accurate this stuff is. Markets know and relate to these Danielcode numbers. I've been proving that to you since 2007. If you doubt it, go to the Danielcode website, click on the tab that says Chart Archives, and in there you will find over 45,000 charts that I have created by hand since the website went public in late 2007. And you will be hard pressed to find a market that has ever turned anywhere except at these Danielcode numbers. And the great tragedy is that I spend endless hours, I assure you, doing these members charts. That's not the tragedy, that's my work. The tragedy is so few of you are getting the benefit of it because you're not going to get the numbers every day or twice a week at least, and putting them on your charts to see what markets do when they get there. By and large, markets are trying to tell us what they are doing. And they do that in separate ways, some by the shape of the bars, some by other issues. But boy, if you didn't know these numbers, you didn't have a clue what was happening today. And that's what we had. Here's Germany's DAX. I'm showing you how these markets have become disorganized. It's rallying very, very well from its low. And It hasn't even reached the 74.9% number in the Danielcode yet. It's certainly nowhere near challenging the black line. Now remember, the Dow closed way above the black line on its market. So you've got all of these markets, all these equities markets that are usually so highly correlated, and they're all out of whack. They're all out of sync. They're not in sync. And that's telling you the level of disorganization and therefore probable weaknesses in the equities. So this is at today's value. And you can see that that same number, 688,150, that was the black line in the S&P. That's set it up, the 2 days failure, to give you a turn. How does the market make a turn? Well, this market rushed through the black line, hit the blue line at 69.01, turned up its toes and said, that's it. And how nice was that? The 69.01 was the blue line. The high, which was done weeks ago, incidentally, the high on Wednesday in the S&P was 6900.5. In other words, 0.5 away from the blue line. In the S&P, that's 2 ticks, folks. 2 ticks. There's a wonderful 6-day chart that many of you haven't seen, but you can just see these markets, even in the 6-day chart. They're so precise, they're so accurate. You simply don't understand how accurate this stuff is. That's why I spend, 100 hours doing charts every week. It is so valuable, but it's not valuable if you're not using it. You've got to go and get these numbers from the website and put them on your chart. If you get a big move, they'll be updated. Normally they're available on Sunday night and on Wednesday night when we update them. If you get big moves, we'll update them as often as required, maybe every day if required. And we could be close to getting some big moves. This market's got enough weakness in it that if we can get a close below the low of this particular rally, that's going to set us up for a decent move further down. And it could get volatile because, as I say, the babies who are playing this market have never seen a bear market. They don't know what to do. And what they're going to do is panic. That's the usual reaction of human beings when they don't know what they're doing. This is the NADAQ. Same thing. Look at it trying to hit on this black line. Up it goes on 4 days ago. So there's Thursday, Wednesday, Monday. The high of that bar is almost exactly on the black line, but the close is below the black line. Next day, Tuesday, it tests the black line, it pushes through it soon after the open and then reverses. And what that actually gives you is a key reversal bar, which can be a powerful indicator. The very next day, Wednesday, it repeats the trick. Wasn't happy with that test, so it'll test that 25,000 number again, which it does, and then it reverses and it creates a second key reversal bar. Okay, and that's why we had all the sell signals in these markets. All of the equities had Danielcode sell signals on them for today, and you can see lovely big move down. Not massive, not exciting, not really scary, but it has the potential to be something much more. So stay tuned with a real reference and observance to it. This is the Russell, and you can see how weak it was leading into Wednesday's rally. Where did Wednesday go? Straight to the black line. 2487.9 was the black line for the Russell. The high of that bar on Wednesday was 2487.6. That's 3 ticks variance, folks. 3 ticks, it's nothing. That happens all the time. How accurate are these things? Same as always. Very, very accurate. Key reversal bar on Wednesday at, not just any key reversal bar at a Danielcode number. That makes it 100 times more powerful. That's the nice sell-off today. this market actually closed below its black line on the last two retracements and eventually pulled up near the blue line at 23.81. Had a little bit of a rally really late in the day. So here is soybeans. It's showing you what happens when the market closes above the black lines successfully. And what you had here is on Wednesday, you had a close, it's all taken on the close, 1133 correct 6. That little arrowhead you see on the grains charts is called, and on the bonds chart as well, of course, it's called a caret, C-A-R-E-T, and its close on Wednesday was 1133 correct 6. Where was that black line number? 1133 correct 2. That's 2 ticks. Grains moving 2460. That's 2 ticks above the black line. How accurate is that? Gave it permission to take out the old high, which it did, and then some. Lovely big move, continuation of that recent rally that we've been trading. Here is another market, natural gas. Have a look what happened here. Very, very telling. In this particular market, you had a black line sitting there at 4594. The market tested it on Tuesday and Wednesday, girded its loins, broke through the black line today, quite noticeably, and then got all the way up there, that high, up near 46.88, and said, oops, sorry, didn't mean to do this, now I'm scared. And it ran all the way back down to close at 45.86, 45.86, 4.586. Where's the black line? 45.94, just underneath it. In other words, do excuse me, this market is not ready to rally past that black line. It could well have another go at it tomorrow. It can keep trying as long as it likes. Sometimes it'll bash away at that back line for days and days and days. This pullback, though, signifies considerable weakness potential in natural gas, which is why the Danielcode has a sell signal on it at the moment. So if you'd like to learn to do this stuff, there's a number of ways. One is our new Teach Yourself to Trade video series, which is not so new now, but I've got these 4 videos on the Danielcode website. And video 1 is from a gentleman, Mark L., who's a retired engineer in the States. The second one is from Justin, who's with us today, talking about their experiences and results when they were back testing Danielcode time signals. And video 4 I've spoken to you about before. This was Justin's pièce de résistance, marvelous, huge amounts of work, looked at, analyzed the Danielcode time trading signals over more than 100 years of data, and he sets them all out for you in that video. It will run for about 35 or 37 minutes from memory. That might be the most important thing you do if you're a trader. It might be the most important thing you ever do. Have a look at it. Just go to the website, click on the link, and listen. Okay, so that's one of the methods you can learn by, and with your invitations to today's webinar, I've attached a PDF that sets out in some detail what the various lessons in the TTT series are, and you can have access to that anytime you like. Let me know. As well as that, we still do the big tutorials. They're one-on-one personally with me, and we've just had a couple of gentlemen about to start the full tutorial Beyond Masterclass. And of course, depends how keen you are on learning and how much you want to know. But within what we offer, you will find everything that is worthwhile knowing about financial markets. So this is what's been happening in the S&P lately. We had a TO3 and blue line sell signal at the recent high. We traded it down into that great big huge reversal bar that sucked all of the joy out of the move, or a good fair bit of it. Left us $5,000 though. Little rally up, we've been right on top of that. 4 days up, and today's sell off in accordance with the Danielcode signals. So $14,000 is not a huge deal. It was very nice, and together with the other trades that we're in today, they're all add up, grist for the mill. Have a look at the NADAQ, that original TO3 and blue line sell signal from the high at 26,375. That was 13,500 straight down into that same reversal bar. Not much going up, a couple of $1,000, and down $6,500 today. Again, this market has closed well off the low. That stops it being particularly bearish, but there are probabilities that it goes a bit further. Remember, there's a huge amount of seasonality in the S&P, and for that seasonality, Thursday is the most bearish day of the week, and Friday is the most bullish day of the week. So probabilities are you get a small weak rally tomorrow, Friday. Okay, that was what we were doing in the NASDAQ. This is what we did in the Russell, 2,900 today, pretty easy. Standard TO3 plus sell. The market had already made the turn and made it with exactitude off the 2487.9 number. As I said, only 3 ticks variance from that. Here's silver, which has been on a roar until today. Today, it hit the blue line at 54.27, and it set us up with a classic key reversal bar. Key reversal bar is a bar that will open inside the range of the previous bar, make a new high for the move, then reverse and close below its own open and below the previous day's close. These can tend to be very powerful signals, but that really simple buy off a correlated buy signal correlated with gold, because gold and silver are so correlated that a signal in any one can be executed in any other. Just give me a moment, folks, would you? Right, a nice cup of coffee in the morning, although it's just early afternoon now in the beautiful Gold Coast, where every day is fabulous. So key reversal bar, that might be enough for it for the while. It took out its old highs, so it managed to knock out the stops, all of them that were there. We'll see what happens. There's a sell signal for silver tonight as well. What else did I have to show you? Let me see. Oh, UST bonds, pretty feeble, nothing exciting about it. Standard TO3 sell moved down, did close very near its low. That might extend a bit further tonight. I would expect that if things get rough, this UST bond is going to get into a position where it becomes very, very exciting. And those of you who follow us regularly will remember the monthly chart in T bonds that I show you periodically. Here's gold. $17,000 on this current trade that we're in long, 17.9 on the short from the TO3 and blue line sell signal up at 4,400, and the average daily range of this market, folks, the ATR, which we calculate on a 29-day cycle, is now over $13,000. That's the 1 day's range, over $13,000. Extraordinary, isn't it? And the day trading potential for gold, let me tell you, Michael, and you others who've done the day trading course, is absolutely fabulous. A lot of money, a lot of money. This has actually given us another key reversal bar. Look how accurate this is. The high of today's bar is 42.50. Where was that blue line? 42.50.3. 3 ticks variance. There's not even a hair on the chart. 3 ticks variance, hits the blue number with exactitude, key reversal bar, probably need to be short tomorrow, follow the Danielcode signals. Okay, here's our little offering of a Forex. We are short, we got long Canadian dollar Swiss franc pair, CAD chief. We got long and we had a flip me signal that got us short on Wednesday, and then today it paid off with a really decent sell down, finding support at the black line of 56.47. This is the Euro-Japanese yen pair. We had a standard TO3 buy signal, $1,600 straight up, lodged itself at the blue line at 179.831. Can you see why you got to have these numbers on your charts, folks? If you don't have these numbers, you're not going to understand what markets are doing. Here's the euro, the USD euro pair, $1,300 straight up off a standard TO3 buy signal. Really, really simple, easy trading. Remember, everything that I show you about markets, I'm talking about one contract only. So it doesn't reflect actual trading because with these markets with smaller margins, you I'm at least trading multiple numbers of contracts. This is the British pound Japanese yen pair, closed above its black line at 203.675, which gives it the opportunity of going up and taking out its old high, which you can see lodged itself in at the blue line at 205.317. This is the dollar CAD, the loonie, Canadian dollar US dollar pair called the loonie. Nice accurate trading, easy rally up on a TO3 buy, hit the red line in there with its low at 14102. Had a sell signal for that, down it goes. 500 down, 700 up, 500 down, 90 bucks up today. Not huge, but if you've got enough of them, it all adds up, I promise you. And so that will bring you up to date on what I'm thinking about and what you should be thinking about. And for the time being, please, if you haven't already, do help yourself to a free trial. Simply go to the website, click on the link that says free trial. If you have any problems at all, contact Terry at support@thedanielcode.com. And finally, for today's meeting, this is our disclaimer, which basically says, do not risk real money trading unless you know what you're doing, unless you are sure that you are a safe and competent trader. It is very, very easy to lose money in these markets if you do not know what you're doing. In the same way, if you get into a motor car and you don't know how to drive, it's very, very easy to do substantial damage to yourself and others, so don't do it. The same thing applies to trading financial markets. Don't risk real money until you can convince yourself and be a hard taskmaster that you actually know how to trade. And the simplest way to do that is do one or other of the Danielcode TTT Learn to Trade video sessions, or better still, do a one-on-one private tutorial with me. So there we are, folks. Market's very exciting today. Lots to think about, lots to think about, and a whole lot of money to count as well, isn't it? Pretty nice stuff. So good, Jeff. Jeff liked that. Good on you, mate. Always lovely to hear from you. Thank you for being with us today. Hope you're trading well. So that's me for the day, folks. I'm off to have lunch with Mickey Dougal, who some of you have heard me about before. And he's driven down from his property, and he's taking me to lunch very shortly. So for you folks, enjoy the weekend coming up, and you've still got trading for tomorrow. Danielcode signals are all posted, and you follow the Danielcode, you'll always be on the right side of the market. Thank you for being with me, and bye-bye for now.